financial instrument. See that? Financial instrument, financial instrument, financial instrument, financial instrument is a financial contract. Financial instrument is a financial contract. Financial instrument is a financial contract, which gives rise to a financial asset to one party, which gives rise to financial asset to one party, and a financial liability, and a financial liability, and a financial liability, and a financial liability to the other party, and a financial liability to the other party, and a financial liability to the other party. E.g., debenture, comma, loan, cash at bank, equity, yeah, etc. Good. Now let's look at terminologies. Now we define financial assets. Financial asset, right, is that? It's any asset that is, semicolon, first bullet, cash, second bullet, contractual rights, to receive cash, contractual right to receive cash, or another financial asset, contractual right to receive cash, or another financial asset that is potentially favorable, So that's what we call a financial asset, not just necessarily a financial asset, but any asset. So for any asset, we say that in this case, there is a contractual right, or you have a right to receive something of which the conditions are favorable. But for liability, the conditions are unfavorable because we expect an outflow. Number two, financial liability. Financial liability, let us say that. This is a contractual obligation. This is a financial, sorry, this is a contractual obligation. To deliver cash, or another financial asset, under the condition that are potentially unfavorable, under the conditions that are potentially unfavorable, Good. So that's the difference between a financial asset and a financial liability. So now let's look at classification of financial instruments. Classification of financial instrument. Classification of financial instrument. classification of financial instrument. Number one, financial asset. Number one is financial asset. Number two, financial liability. Number two is the financial liability. Number three, equity instrument, equity instrument, equity instrument. And number four, derivatives, 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 derivatives. Those are the classifications of financial instruments. And they are classified into four. Number one, they're saying that we have a financial asset. Number two, we have financial liability. Number three, we have equity instrument. And number four, we have derivatives. Now, derivatives will be mostly applicable. They are financial instruments that are applicable globally or international markets, which involves the swaps, forward contract, future contract, all that, including the swaps. Good. So now let's start with financial asset. Financial asset. Financial assets. Financial asset. We have already defined what's a financial asset. Let me say that. IFRS 9 revised version, IFRS 9 revised version classifies financial assets, classifies financial asset into three, classifies financial assets into three. Yeah, so in short, there are three types of financial assets. So first of all, let me explain, don't write. Number one, we have financial asset at fair value through profit or loss account. Then number two, we have financial asset at fair value through OCI, through other comprehensive incomes. These are what we call available for sale. Available for sale. And then number three, have financial asset at amortized cost. Those are the three types of financial assets. Now, the difference is that financial asset at fair value through P&L, these are short-term financial assets, which are held for trading. So therefore, they are held for trading, of which in that case, the fair value changes. That is a fair value gain or a fair value loss will be recognized to profit and loss account. Yeah, either a fair value gain or fair value loss will be taken to the P&L. Then number two is financial asset at fair value through OCI or the available for sale. Now, these are long-term financial assets. That means where the company expects to hold them on a continuous basis. And in this case, the fair value changes, that gain or loss, will be recognized to other comprehensive incomes. And then we have financial asset at amortized cost. Also, these ones are long-term in nature, but they are purely debt element. Purely debt element. For example, a bond, a debenture, a loan note. But if that loan note or maybe a debenture is convertible, that means can be converted into share. That means it has an equity element. that one does not qualify to be a financial asset at amortized cost. Because we have two models we have to meet for it to be classified at amortized cost. There is the cash flow characteristic and what we call the business characteristics. So in this case, it contains only pure debt element. So in case there is any conversion rate, that one disqualified from being at amortized cost, it becomes a financial asset at fair value. So now let's start with number one. Number one, you're saying that IFRS 9 classifies them into three. So number one is financial asset. Number one is the financial asset at fair value. Financial asset at fair value. Financial asset at fair value. Through profit or loss account. Through profit or loss account. Then we explain, see that? These are short-term financial assets. These are short-term financial assets. These are short-term financial assets held for trading purposes. 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 Another sentence with that. Initially, they are recognized. Initially, they are recognized at fair value. Initially, they are recognized at fair value, which is normally cost, which is normally the cost. It's normally the cost incurred, which is normally the cost incurred. And this will exclude, and this will exclude, and this will exclude, and this will exclude transaction cost, and this will exclude transaction cost, which will be charged to the income statement when incurred, which will be charged to the income statement, which will be charged to the income statement when incurred, be charged to the income statement when incurred. And then below it, we look at subsequent measurement. Subsequent measurement. And you see that initially you recognize them at fair value, which will include only the cost. Transaction cost will not be included because it will be taken to the income statement when incurred. How do you measure them subsequently? Right, you see that? Subsequently, they'll be remeasured. Subsequently, they'll be remeasured at fair value. They'll be measured at fair value. With the movement or with the changes in fair value, taken to profit and loss account, for the year. So you're saying that initially you measure them at fair value. Subsequently, you also measure them at fair value with any changes in fair value, be it a fair value gain or fair value loss, you take it to the P&L. Good. Number two, financial asset at fair value through OCI, stroke available for sale, Financial asset at fair value through OCI, stroke available for sale. So that these are long-term financial assets These are long-term financial asset. These are long-term financial asset, full stop. They are typically applicable. They are typically applicable. They are typically applicable. They are typically applicable for equity. They are typically applicable for equity instrument. For equity instrument that an entity intends, that an entity intends, that an entity intends, that an entity intends to retain ownership, that an entity intends to retain ownership on a continuous basis. And to expect or intend to retain ownership on a continuous basis. Good. Another sentence. Initially, they are recognized at fair value. Initially, they are recognized at fair value, which normally includes the associated, which normally includes the associated transaction cost of purchase, which includes the associated transaction cost of purchase. Transaction cost of purchase. After that, I hope you can be able to identify the difference between the two. Now, under the short term, that's financial asset at fair value. Initially, they will be measured at fair value, which will be measured at cost, but you exclude any transaction cost. You exclude the transaction cost. So transaction cost will be taken to the P&L immediately. But for this long term, that's financial asset at fair value through OCI. Initially, they'll be measured at fair value, which is the same as cost, but also include the transaction cost, the cost that was incurred. That's what we call preliminary expenses. So here the preliminary expenses will be capitalized. The preliminary expenses will be expensed. That's the difference between the two. All right, so on the second one, now let's look at subsequent measurement. Subsequent measurement. Subsequent measurement. Subsequent measurement. See that? Subsequently, they are measured at fair value. Subsequently, they are measured at fair value with the changes in fair value, taken to other comprehensive income, with the changes in fair value taken to other comprehensive income for the year, taken to other comprehensive income for the year, which will effectively incorporate annual impairment review. Annual impairment review. Annual impairment review. Annual impairment review. Number three, that is financial asset. Financial asset at amortized cost. Financial asset at amortized cost. Financial asset at amortized cost. Like to say that this classification can apply only. This classification can apply only to debt instrument. Yeah, to debt instrument. And must be designated upon initial recognition, and must be designated upon initial, must be designated upon initial recognition, full stop. For this designation to be effective, to be effective, comma, the financial asset must pass. The financial asset must pass. The financial asset must pass two tests as follows. Must pass two tests as follows. Must pass two tests as follows. A business model test is business model test. Business model test. Yeah, what does it entail? Let us see that. To pass this test, comma, the entity must be holding the financial asset. The entity must be holding the financial asset to correct contractual cash flows, associated with the financial asset, to correct contractual cash flows associated with the financial asset, to correct contractual cash flows associated with the financial asset. If this is not the case, comma, such financial assets being held for trading purposes, will be reclassified to financial asset at fair value, through profit or loss account, Yeah, so that's what we call the business model test, that you must be holding that financial asset only to earn the contractual cash flows. Yeah, for example, if it's a debt instrument, you have invested in a bond, you expect to get two types of cash flow. One, it's an annuity, that's the interest, and then upon maturity, you get back your principal. Good, so that's what we call the business model test. B, cash flow characteristic test. Cash flow characteristic test. Yeah. You see that? To pass this test, comma, the contractual cash flows, corrected, must consist solely of payment of interest, and capital, Full stop. And okay, is that one example of financial assets one example of financial asset, one example of financial asset that would fail this, that would fail this test, that would fail this test is convertible bond, is convertible bond, is convertible bond. So if it's convertible, that means it's not purely a debt. There is an element of equity. So therefore, that one does not qualify to be financial asset at amortized cost. It is saying you take it back to the financial asset at fair value through OCI. And what are those? How do we call these convertible bonds? Now, they are known as the compound financial instrument. The financial instrument with both the debt and the equity. So actually, we have explained everything. Financial asset at fair value through P&L, through OCI, and financial asset at amortized cost. So I want us to explain something else to do with compound financial instruments. What are compound financial instruments? Let us see that. You see that? These are financial instruments. These are financial instruments. These are financial instruments which contains both, which contains both equity and debt element, equity and debt element, equity and debt element, equity and debt element. In such a case, comma, the standard requires, in such a case, comma, the standard requires the component parts, the standard requires the component parts, the standard requires the component parts of the instrument, the component parts of the instrument, the component parts of the instrument to be classified separately, to be classified separately according to the substance, to be classified separately according to the substance, of the contractual arrangement, according to the substance of the contractual arrangement, An example of compound financial instrument, an example of compound financial instrument is a convertible debt. Is a convertible debt. Full stop. This creates a primary financial liability. This creates a primary financial liability. This creates a primary financial liability of the issuer. Financial liability of the issuer. Now, issuer is the borrower. Of the issuer, and grant an option to the holder, and grant an option to the holder, and grant an option to the holder of the instrument, and grant an option to the holder of the instrument to convert it into equity, and grant an option to the holder of the instrument to convert it into equity instrument. Convert it into equity instrument. Full stop. Then you can write another paragraph, right? To see that. The debt element of the financial instrument, the debt element in the financial instrument, the debt element in the financial instrument will be determined at amortized cost, 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 while the equity element, while the equity element, while the equity element, while the equity element will be the residual value, while the equity element will be the residual value, will be a residual value, will be the residual value after deducting, will be the residual value after deducting debt element, after deducting debt element, deducting debt element from full value of the instrument, after deducting debt element from full value of the instrument, full value of the instrument. Good. That's what we call a compound financial instrument, an instrument that contains both equity and debt. So you think that in this case, it will have an equity element plus the debt element. They're saying that to get the debt element, you measure it at amortized cost. Now, amortized means that, what do you mean by amortized? Amortized is the same as the fair value, where it determines the present value of the future cash flows. So that's what we call the amortized value. So once you get the debt element, how do you get the equity? You take the full value of the instrument, you eliminate the debt element. Now, residual will be your equity element. Good. So look at something else. Measurement and recognition. Measurement and recognition of financial instrument. How do we measure and how should we recognize financial instrument? You see that? A financial asset and financial liability, a financial asset, a financial asset and financial liability, a financial asset and financial liability should be recognized in the financial statement, should be recognized in the financial statement, should be recognized in the financial statement, should be recognized in the financial statement when the reporting entity, becomes a party, when the reporting entity becomes a party to the contractual provision, when the reporting entity becomes a party to the contractual provision of the instrument. When the reporting entity becomes a party to the contractual provision of the instrument. Yeah, so that's one of the recognition criteria, that you should only recognize if you are party to it. That means, you see, we are saying that a financial instrument is a contract that gives rise to an asset to one party and a liability to another party. Now, for example, if you buy government bonds, you invest in government bond maybe worth 1 million. So in this case, you have bought. So the issuer is the government. So that means in this case, you are the one investing. So if you buy that debt instrument, it becomes an asset. Because it's an investment, it's an asset. You expect some future cash flow in terms of interest as well as the principal. What about the government? Yeah, to the government, that one becomes a liability. Now, if you buy shares of a company, that's the equity. You invest in shares, so investing, so you're buying the share. So if you buy the share, it becomes a what? You recognize them as an investment, which is part of their assets. What about the company? Yeah, it becomes a liability. That's why we recognize equity and liability. Now, equity means that the company, they have the money that does not belong to them. It belongs to the shareholder. So they are just acting as custodian. So that's what we call a financial instrument. A contract that gives rise to an asset to one party, a liability to another party. Also, you mentioned about the cash at bank. If you take your cash to the bank, 2 becomes a what? So you have some cash in your bank account, right? So 2 is an asset, right? What about the bank? Yeah, it's a liability. That's what we call a financial instrument. So you're saying that you only recognize financial instrument if you become a party, whether it's an asset to you or a liability. Then how do we recognize them or how do we measure them? So we start with initial. Yeah, so initial recognition. How do you recognize financial instrument initially? Initial recognition. Yeah, so in this case, I just want you to understand, don't cram, is something we have mentioned. Now, all the financial instruments, whether it's an asset, whether it's a liability, whether it's an equity, all the financial instruments, initially, they'll be measured and recognized at fair value. Plus or minus, now that means the changes in fair value, taken either to P&L, if it's a short-term financial instrument, or to OCI. That all financial instruments will initially be measured at fair value. Plus or minus the changes in fair value, either to P&L or OCI, depending whether it's a long-term or short-term. What about subsequently? Subsequently, also, you measure them the same. That is, subsequently, you can also measure them at fair value, plus or minus changes in fair value to P&L or OCI, or at amortized cost. I think that amortized cost is all about determining the present value of all the future cash flows. So initially at fair value, plus or minus to P&L or OCI, also subsequently the same at fair value through P&L or to OCI, or you measure them at amortized cost. But amortized cost only will apply to the debt instrument, such as bond, debentures, loan note, etc. So we write, so you're looking at initial recognition, it is that, or financial instruments, or financial instrument, are initially measured at fair value, are initially measured at fair value, plus or minus changes in fair value, plus or minus changes in fair value, either through P&L, that's profit and loss, or OCI, either through P&L or OCI, with exemption to receivables, that do not contain, that do not contain significant financing component, with exemption to receivables that do not contain significant financing component. Can write in bracket, receivables will be measured at transaction cost. Receivable will be measured at transaction cost. Measured at transaction cost. And now let's look at subsequent measurements. Yeah, so that was initial recognition. What about subsequent measurement? So we are looking at subsequent measurement. Let me say that. Subsequently, or financial instrument, subsequently, or financial instrument, are measured either at amortized cost, or at fair value, plus or minus changes in fair value, or plus or minus changes in fair value to P&L, or OCI, to P&L or OCI. That's other comprehensive incomes. Good. So that was measurement and recognition. So now we look at the recognition of financial instrument. The recognition of financial instruments. Yeah, when you talk about the recognition, we are talking about the opposite of recognition. Recognition is to include. The recognition, therefore, is the removal of a previously recognized financial instrument. So at what point of time do you recognize a financial instrument? Now, I take you back to the scenario you had. You had invested 1 million Kenyan shillings in government bonds, maybe for 4 years. So what will happen after 4 years? After 4 years, it will mature. The government will give back your money, right? But you see, now you have included as part of an asset because it's an investment to you. But upon maturity, when you receive back your money, you remove it from your financial instrument, financial statement, because it's no longer an asset. Because why? The contractual right to receive cash flows have already expired. So that means that's one of the criteria upon maturity. Another case, you had shares worth 1 million in XYZ Limited. Those are your shares. At what point of time will you remove them from your financial statement? Because if you buy shares worth 1 million, it's an asset, it's an investment. You expect some future benefits in terms of capital gain as well as the dividend. At what point of time will you remove them from your financial statement as an asset? Yeah, when you sell. That means you sell or you transfer them to another party. So that means upon disposal or when you transfer to another party. Right to say that? The recognition is the removal. The recognition is the removal of a previously recognized. The recognition is the removal of a previously recognized financial instrument, of a previously recognized financial instrument from entity's financial statement, from the entity's financial statement. It happens under the following condition. It happens under the following condition. Semicolon. A. When the contractual rights to receive cash flows, have expired, when the contractual right to receive cash flows have expired, in bracket, upon maturity, upon maturity. And number B, when the asset has been transferred, when the asset has been transferred to another party, when the asset have been transferred to another party, alongside with the risk of ownership, alongside with the risk of ownership, alongside with the risk of ownership. Yeah, those are the two conditions under which you need to recognize a financial instrument. Also, IFRS 9 incorporates IAS 36. IAS 36 is what we are doing in our last session, which was under what? Impairment. Good. So now let's look at impairment of financial instruments. Impairment of financial instruments. Right. IFRS 9 effectively incorporates an impairment review, for financial asset, for financial assets that are measured at fair value. Incorporates an impairment review for financial assets that are measured at fair value. Good. So we look at indicators of impairment loss of a financial instrument or financial asset. Indicators of impairment loss, of financial asset, Yeah, so what are some of the indicators that your financial asset might be impaired? Number one, significant financial difficulty. By the issuer, stroke borrower. Significant financial difficulty by the issuer, stroke borrower. Number two, breach of contract, such as a default in payment, of interest or the principal. And number three, another indicator. When it becomes probable that the borrower, might enter into bankruptcy. Becomes probable that the borrower might enter into bankruptcy. I remember when the borrower enters into bankruptcy, you cannot receive back your money. Another one, point number 4, disappearance of active market, for that financial asset, Yeah, those are some of the indicators of impairment loss. Lastly, there is something we are mentioning on how to measure financial instrument, and we are mentioning fair value. So how do we apply the fair value? Now, fair value means what? Market value. For example, if you want to buy a land, so always you assess the market value, right? Yeah, that's what we call the fair value. So how does fair value apply? So we look at fair value hierarchy. Fair value hierarchy of input measurement. Yeah. How do we apply the fair value? Let me say that. Fair value hierarchy, fair value hierarchy, fair value hierarchy categorizes fair value hierarchy, categorizes the input used in valuation technique. Fair value hierarchy categorizes the input used in valuation technique. Fair value hierarchy categorizes the input used in valuation technique into three levels. Number one is level one input. Level one input. Level one input. Level one input. Explain to see that. Level one input. Level one input. Level one input entails quoted prices. Entails quoted prices. Entails quoted prices in the active market. Level one input entails quoted prices in the active market for identical assets. For identical assets. For identical assets. Yeah, can you underline quoted prices? Underline quoted prices. You underline the quoted prices. Number two is level two inputs. We're done with level one. Now we are in level two. Level two input. Let's see that. Level two inputs. Level two inputs are inputs other than quoted market prices. Other than quoted market prices. Other than quoted market prices. Other than quoted market prices that are observable for an asset or liability. That are observable for an asset or liability, either directly or indirectly. Either directly or indirectly. Either directly or indirectly. Yeah, can you underline observable? Underline observable. Observable. Then lastly is level three input. Level three input. Level three input, right? So that level three input, level three input, level three input, level three input entails an observable entails an observable inputs for an asset or liability. Yeah, so those are the fair value inputs. The one we are saying that it's all about the quoted prices. Yeah, you are selling this land at how much? 3 million. So that's what you call level one. Then step number two, go to level two inputs, whereby you look at observable. Observable inputs. For example, in this case, you look at, now I want to invest 3 million in this land. So do we have social amenities? Do we have schools? Do we have power? What about the infrastructure? Those are what we call the observable inputs. Then level three inputs, now it's an observable, such as weather or the climate of the area. What else? Would you mind? flooding, rights, it is. You cannot observe them. Yeah, good. So can you open with me this question? Open with me. April 2023. April 2023. Question 4B. April 2023. Question 4B. April 2023. Question 4B. Yeah. Fair value hierarchy. This one is under IFRS 13. Okay, let me just read for you a question if you have not found the question. Probably you are told that the objective of IFRS 13 fair value measurement is to provide a single source of guidance for fair value measurement where it is required by reporting standard rather than it being spread throughout several reporting standards required. In light of the above statement and citing examples, briefly describe three hierarchical level input required by IFRS 13 fair value measurements. Yeah, the three of them, level 1 input, level 2, and level 3. Get your 6 months. Open with me April 2024. April 2024. Yeah, question 1C. Question 1C. Question 1C. Now, once you are told that Q Limited holds the following assets measured at fair value. Required. Identify the input used in each measurement of the above assets and explain how the valuation corresponds to the fair value hierarchy of IFRS 13 fair value measurement. Let's start with number 1. Listed equity shares measured at quoted prices. Yeah, that's level 1. Number 2. Land held for sale, which is measured at fair value by reference to the sales price of comparable land in similar location, that is price per square meter, adjusted for key attributes such as land size. Yeah, that is level 2. It's observable. Look at the size of the land. I want a ranch. I don't want a caprot. Number 3. Investment properties whose fair value is measured using an income approach based on discounted estimate rental income to reflect the current market rate per square meter. Read that again. Just read that again before you answer. Which level is that? Yeah, that one even guess. So you have level 1 and you have level 2. That one becomes level? Level 3. You see now, rent or rental income number sometimes is determined by the demand of the houses. So can you be able to observe it? Oh, so that one goes to level 3. Good. So we take a small break, then we come and do some illustrations. NB, NB, NB. Number one. Annual coupon interest, annual coupon interest, annual coupon interest, annual coupon interest is computed based on the par value, computed based on par value. Number two, coupon rate refers to the rate attached, coupon rate refers to rate attached to a financial instrument, rate attached to a financial instrument at the date of issue, rate attached to an instrument at the date of issue. Number three, effective interest rate. What is effective interest rate? This refers to the current market rates. This refers to the current market rate. Number four, fair value or amortized cost. Fair value or amortized cost. This is the present value. This is the present value of future cash flows. This is the present value of future cash flows. This is the present value of future cash flows. Present value of future cash flows. Good. So now we do some illustration. Handout. Question 1, page 2. Handout. Question 1, page 2. You see it? Handout question 1, page 2. You are told that on 1st of January 2012, Mark Limited purchased. So Mark purchased. Is it a financial asset or financial liability? Are we there? Mark purchased a debt instrument. Now to Mark, let's assume to me, is it a financial asset or financial liability? Asset liability. Well, it's an asset. You see, if Mark purchased, if, for example, the government will issue the bond, I purchase the bond. The company will issue the share, I buy the share. So if I purchase, to me, I'm investing. That's what I mean to invest. Now, the party that issued, the government issued the bond, they are the one borrowing. The company issued share, they're issuing share so that they get your money. So to them becomes a liability. So if you purchase, it becomes an asset. If you issue, it becomes a what? A liability. Good. So I do that. On 1st of January 2012, Mark Limited purchased a debt instrument at its fair value of 1,000. The debt instrument is due to mature on 31st December 2016. So that means it's for 5 years. Interest on the debt instrument is at the rate of 4.72% coupon rate. Now that coupon rate is the rate we agreed you'll be paying me, or I'll be receiving each year. That's what we call the coupon date. You see that is the rate attached to a security at the date of issue. So that means the coupon cash flows, which is an annuity, is the same. We agreed that I'll be receiving, because 2 is an asset, so you expect to receive the interest at the rate of 4.72% of the par value of the principal amount. You know that the instrument is due to mature on that 1st of December 2016. Interest on the debt instrument is at the rate of 4.72% coupon rate that is payable at the end of each year. The instrument has a principal amount of the par value of 1250 payable on maturity. So the principal amount, which is the same as par value, and that par value is what you get when it matures. You give them 1 million, after 3 years, you get back your 1 million. So therefore, the coupon cash flow is 4.72% of the par value, which is 250. And this 1250 will be also the maturity value. It will mature at always at par value. So how much did we agree you'll be paying me each month, each year? An amount of 50? Like this is what I'll be receiving at the end of each year. The effective interest rate is 10%. You see that effective interest rate is what? Yeah. We have said it's 10%. We have said effective interest rate is the current market rate. Now, whenever you're given 2 rates, there is a rate we agreed, and then there is market rate. Now, you need to amortize that debt instrument or that financial instrument. You need to amortize. Required. How should Mark Limited account for this debt instrument? Let's read that again. On 1st of January 2012, Mark Limited purchased a debt instrument at its fair value of 1,000 shillings. That's the fair value. So initially, we recognize it at fair value. Remember, that's what you said. That initially, it will be recognized and at fair value, of which we are told that the fair value is 1,000. But sometimes not be given. You compute. The debt instrument is due to mature on that 1st of December 2016. That's after 5 years. Interest on the debt instrument is at the rate of 4.72% coupon rate that is payable at the end of each year. The instrument has a principal amount, that's the par value, of 1250 payable on maturity. The effective interest rate is 10% required. How should Mark account for this debt instrument? He invested in a debt instrument, so you account for it at amortized cost. So to come up with amortization schedule for 5 years. So here we have years. So it purchased on 1st of January 2012. So it's 2012, 2013, 2014, 2015. Then it will mature in 2016. We have the opening balance. Then it will attract the interest. So we have the interest income. Remember, to Mark, it's an asset. So an asset gives rise to an income. Now, the interest earned will be based on the current market rate. That's the effective interest rate, which is at the rate of how much? 9%. But there is the coupon cash flows. Now, the coupon cash flows is based on the coupon rate, the one we agreed at the date of issue, which is an amount of 59 at the rate of 4.72, so that we get our closing balance. Sorry? Oh, this was 10, not 9, eh? Good. 10%. Good. So how do you account for it? So initially, you measure it at fair value. And how much is the fair value? And because I know that on 1st of January 2012, Mark Limited purchased a debt instrument at its fair value. That is 1st of January 2012 at the beginning. The fair value of 1,000. Then I told that the debt is due to mature on that 1st December 2016. Interest on the debt instrument is at the rate of 4.72% coupon rate that's payable at the end of each year. The instrument has a principal amount of par value of 1250 payable on maturity. So it will mature on that 1st of December 2016. Payable maturity, we get back an amount of 1250. So how do we amortize so that we determine how will I be accounting for it at the end of each period? So first of all, I determine the interest. So here the interest and based on the market rate, I was run an interest of how much? 100. But we agreed you'll be paying me 59, 59, 59, 59. So the coupon cash flow, that one is an annuity. And this is what I mean. The balance was 1,000, that's the fair value. I earned an interest of 100. But how much did we receive? We received 59. You deduct what you have received. How much will be the balance? Okay, you take 1,000 plus 100 minus 59. 1040? 1041. And the balance carried down becomes the opening balance. 1041, you earn interest of 10%, then approximately 104. So this is what you have earned. So take the balance at the beginning, you add the interest and you eliminate what you have already received, an amount of 59. How much will be the balance? 1086. The balance carried down becomes the opening balance. 1086. Then you earn the interest during the year. Let's work with 109. 1086. You add the interest and you deduct what you have already received. How much will be the balance? 1130. The balance carried down becomes the opening balance. 1136. You earn an interest of 10%. Let's work with 113 because here you had loud up. So here you loud down. 1136. You add your interest of 10%. You deduct what you have already received. 1119. 1190. The balance carried down becomes the opening balance. 1190. You earn interest of 10%, an amount of 118. So you take 1190. You add what you earned. You deduct what you have already received. That's how you amortize. Now, how does this affect your financial statement? Now, to the income statement, remember you prepare on accrual basis. What you earned, not what you received. So the interest earned is what will take it to the P&L as an income. Then the balance carried down, you take it to the balance sheet as part of non-current assets. Now, this is what you call available for sale or financial asset at fair value through OCI because it's a wrong term. Are you together? Yeah, so this one available for sale. Year 1, year 2, year 3, year 4, year 5. Then at the beginning of year 6, you derecognize because it has already matured. Good. Another thing. In this case, this was the amount you invested, 1250. That was the par value. But you see that initially we measure them at fair value. Assuming you're not given this fair value, because in this case, you are given the fair value. If you're not given the fair value, go back to NB. The last NB I've written is what? Fair value, also known as what? Amortized cost. What does it entail? This is the present value of the future. I'm saying that assuming you're not given 1,000, because sometimes you'll not be given, how do you measure it? You say that initially it will be measured at fair value. And that fair value, how do we get the fair value or the amortized value? So fair value is equivalent to the present value of future cash flows. In case of that instrument, it has 2 streams of cash flow. That is, to get the fair value, you take the present value of an annuity. Now, an annuity is the interest you receive each year, plus upon maturity, you get back your money or you fund the money. So therefore, there'll be present value of maturity value. So in our case, what do we have? We had annual interest. How much did we agree I'll be receiving each year? 59. This is what we had agreed. So it's 59 times present value interest factor of an annuity, because it's each year for the next 5 years. Then you discount based on the current market rate, not at the coupon rate. How much is the market rate? 10% for the next 5 years. Then you add the present value of maturity value. Upon maturity, you get back your principal, 1250, but it's not an annuity. You'll only receive it once upon maturity at the end. So present value interest factor, 10% here, at the end of year 5. So it will be 59. Here you normalize to use the formula. This financial reporting is not financial management. It's not there. So yeah, use the word, the formula. So how do you get the present value of an annuity? It's 1 minus 1 plus R. R is 10% raised power negative -5 over R 0.1. This is 1250. In case of a single cash flow, it's 1 plus R raised power -n. So it's 1 plus 0.1 raised power -5. Or you can take 59 times 3 point. You want to give you the rate? You know, the good thing, I know them. Okay. Oh, can you compute? Just compute the full amount. You get 999 point? Yeah, it's approximately equal to 1,000. That's how they had determined this 1,000. Good. Before you copy, do another one. May 2018, question 4A. May 2018, question 4, to that. E-Limited issued a bond. Asset liability. E-issued. Is it liability or asset? Yeah, it's a liability. Yeah. If they're issuing a bond, so that they raise the money. So therefore, it's a liability. Now, E-Limited issued a bond for 200 million on 1st of January 2018. Interest on the bond is payable in arrears on 31st of December each year at the rate of 12%. Now, that 12% is what we call the coupon rate. Therefore, our coupon interest is 12%. We have issued a bond worth how much? 200 million. And the interest will be payable at 12% at the end of each year. 12 times 2 get this what, because the liability, this is what they'll be paying at the end of each year. That's what they agreed. The bond will be held to maturity and redeemed on 31st of December 2020 for 258.24. So that means it will mature after 3 years. And we have the maturity value. It will mature at 250? Yeah, 0.24. Good. The effective interest rate is 20%. Now that's the market rate. But how much was the coupon rate? Well, therefore you need to amortize. The bond has not been designated as at fair value through profit and loss. So therefore, if it has not been designated, okay, that's just additional information. But what it means, it's a financial asset at fair value through OCI, correct. So you are told it's not at fair value through P&L. So therefore it's OCI, correct. Required. Charge to the income statement. Now, before you get the charge, we have to amortize so that we determine what do we take to the income statement, what do we take to the statement of financial position. So you come up with amortization schedule. Whereby we have the years. Was issued on 1st of January 2018. So 2018, 2019 will mature in 2020. Then we have the opening balance. Then there is interest expense. This one is a liability. A liability will give rise to an expense, and the interest expense will be determined based on the current market rate. The effective rate is 20%. Then there was coupon payment or coupon cash flows, which that one is based on the coupon rate. Yeah, and then you get the balance carried down. So how much is that? So on 1st of January 2018, we issued bond worth how much? 200. Now that's its fair value, 200. Then it will mature as at that 1st of December 2020. At how much? 258. Yeah, they have the maturity value, which is 258.24. Then the coupon cash flows. We agreed how much will you be paying each year? Yeah, the coupon interest is an amount of 24. That one is always an annuity. Now from there, we amortize. So 200, the market, based on the market rate for the year was 20%. 2020, you get 40. So the balance was 200. You are supposed to pay an interest of 40, but how much did you pay? 24. What you had agreed you'll be paying. So the balance will be 216. The balance carried down becomes the opening balance. 216, this one you get 43.2, right? So you take 216 plus 43.2, you deduct what you had already paid at the end of the year. To that 5.2. The balance carried down will be our opening balance. So we'll have 235.2. 20% of that you get 40. 0.4. You take the balance brought down, you add this, you deduct what you have already paid. You get 258.4. That's how you amortize. So the interest expense is what you take to the P&L, not what you paid, what you are supposed to pay. And then this one, you take it to the balance sheet, which is a liability. So it's a be part of non-current liability. Now we can answer the question. Now the question was, charge to the income statement for each of the 2 years, 2018 and 2019. We just need to show for the 2 years, but we can show all for all the 3 years. Number 2, extract of the statement of financial position. So number 1 is what do you take to the income statement? Let me show how to come up with the income statement extract. We have 2018, 2019, 2020. These are financial liability. A liability gives rise to an expense. So under the expenses, we'll be having interest expense. And these are the interest expense. We have 40, 43.2, we have 47.04. And number 2, what do you take to the statement of financial position? So here under non-current liability, we have a 12% bond. So you take the balance carried down. Year 1 is an amount of 216. We have 235.2, and we have 258.24. Good. Can copy now. Now let's do another one. May 2021 question 4B. Naivasha Limited. Naivasha Limited issued asset liability. Asset liability. It's a liability. And Naivasha Limited issued 500 convertible loan note. Convertible. Now, how do we call such instrument? Or we don't call it? How do you call such instrument? Debt instrument. Equity, no. That's what we call compound, right? Yeah, because it's a loan note which is convertible. So that means can be convertible, can be converted into shares. So that's what we call the compound financial instrument. It is an instrument that contains both the equity and the debt element. And you see that the requirement of the standard is you need to separate the two. You get the debt, or you measure the debt at amortized cost. Then you get the equity by taking the total value, you minus the debt element. The residual will be the equity element. Let's do that. Naivasha Limited issued 500 convertible loan note on 1st of January 2018 at par. So they were issued at par. Each loan note is redeemable in 3 years' time at its par value of 2,000 per note. Each loan note is redeemable. So redeemable, that means you are given the maturity value. It will mature at its par value of 200 shillings per note. But we had issued how many notes? 500, not 3. 500 each at 2. That means the organization was raising how much? That's 1 million, right? So the issued loan note worth 1 million. Alternatively, each note can be converted at maturity date. That's on 1st of January 2021. That's after 3 years. Into 125 10 shillings ordinary share. The loan note pays interest annually in arrears at a coupon interest rate based on the nominal value of 6%. Now, this is what we call the nominal value. Nominal means the par value. The par value is for 1. If you take all the shares, we call them the nominal value. So I told that, read the second paragraph again. The loan note pays interest annually in arrears at a coupon interest rate based on the nominal value of 6%. So the coupon interest that they'll be paying is at the rate of 6% of this coupon. I mean this nominal value. So that means each year they'll be paying an interest of 60. The prevailing market interest rate for 3-year loan note without conversion rate is 9. That is the effective interest rate. So how do you account for that? Now, this is how you account for this. This is a compound financial instrument. Compound financial instrument. Therefore, it has both debt and equity element. Is the requirement to separate the two. How do you measure the debt element? So to get the debt element, be measured at fair value or measured at amortized cost. See that? How do you get the amortized cost? Is the present value of the future cash flows. So therefore, to get the debt element, it will be equivalent to the present value of the future cash flows. Let me just write for you what I'm saying. So therefore, to get the debt element, you'll take the present value of an annuity. And in this case, the annuity is the interest we agreed to be paying each year. 60, 60, 60 for the next 3 years. Then upon maturity, you return back the principal amount. So the present value of maturity or the redeemable value. And how do we get that? So to get the present value of an annuity, this is the annuity, which is 60. And being an annuity, we discount using the current market rate. How much is the current market rate? 9%. So it's be 1 minus 1 plus R raised power negative n, which is 3 years, over R. Then we add present value of maturity value. We have the maturity value. It will mature at its nominal value, 1 million. So you take 1 million. Then it's not an annuity. It will only happen once at the end of year 3. So it's 1 plus R raised power negative n. Now give me the debt element. $9.40? 0.61. So how do we get the equity to get the debt equity element? Now to get the equity element, this I'll get. So we'll take instrument value. Now the instrument value was 1 million. Then we have the debt element. We eliminate the debt element of 924,061. And the residual is the equity element. So that's how you get the equity element. You get 73? 75, sorry? 930? That's how you separate the two. The equity element, which does not change, but for the debt element at amortized cost, then you amortize it. So let's amortize the debt. Prepare the amortization schedule. How do you prepare amortization schedule? So here we have the period. When was it issued? 2018, eh? So it's 2018, 2019, 2020. Okay, okay, the maturity date, okay, it's not on 1st January. Eh? 1st it was issued on 1st of January 2018. It's okay the way it is. See, the money will be funded on 1st of January 2021. How many days from that 1st of December 2020? It's 1 day. Yes. So we'll have balance brought down. Then we have the interest expense. This was a liability. Then we have the coupon cash flows. And that's how we get the closing balance. So we are amortizing the debt element. How much is our debt element? Yeah, this is the debt element. 924,060. Then it will mature after 3 years. How much is the maturity value? It's there. It will mature at its nominal value. Is it 1 million? Yes, a very indicated maturity value for 1 million. Now, at this maturity, that's when now you have an option of taking back your money or to convert them into shares. Good. So interest expense you determine based on the effective rate at the rate of 9%. Good. So give me 9% of 924,061. 160. Then the coupon cash flow. This is what you agreed will be paying each year. An amount of 60. Take that, you add 83, you deduct what you have already paid. Difference is 23. So you get 226. The balance carried down becomes the opening balance. You'll have 947, 226. 9% of that? 85 to 50. You take that plus the interest, you minus what you have already paid. 476. The balance carried down becomes the opening balance. So you have 972, 476. 9% of that? 520. You take that plus that minus that. Yeah, 9. This is approximately equal to 1. Good. Now the question was, what was the question? Prepare extract of the financial statement. How does it affect the income statement? How does it affect the balance? So we have the income statement extract. So we have 2018, 2019, 2020. So under the expenses, we have the interest expense. So we take this 83,165, 85,250, 87,523. Then to the statement of financial position. So we have liability. So under non-current liabilities, we had a 6% loan note. So we take now the balance carried down. So we have an amount of 947, 226, and 972, 476. Then we have an amount of. You can copy now. And now we can call it a day.